Hello friends, how are you all today? I want to talk about PG Electroplast or PGEL for short in this video. This is a B2B business. Major portion of the revenue, that is about 68 to 70% of the revenue, comes from contract manufacturing of home appliances, mainly ACs, washing machines and air coolers. Their client list includes big brands here in India: Voltas, Blue Star, Daikin, Godrej, Whirlpool, TCL, Chroma, etc. etc. They have about 5,000 plus employees working across 11 manufacturing plants all across India. Apart from these home appliances, they also manufacture TVs, and about 12% of their revenue comes from the TVs business, which is known as the electronics division of PGEL. The division which manufactures the ACs, washing machines and air coolers is known as the products division. And they also have a plastic molding division, which 20% of the revenue comes from the plastic molding business. Actually, they started out as a plastic molding company, and just about 4 to 5 years ago, majority of their revenue came from plastic injection molding for and PU painting job done for consumer electronics, consumer durables, automotive components, sanitary ware and mobile accessories. PG Electroplast stock price jumped nearly 300% in just last 1 year. In fact, during the COVID slump, the stock was trading at rupees 3 per share, and now it is trading at around 850 rupees, which is about 285x jump in stock price in just about 4 to 5 years. It's not that they were doing really badly during those times. The revenue was about 642 crores in FY20, and in FY24 the revenue was 2,760 crores. For FY25, the company now has guided for a revenue of 4,800 crores. The profits have gone up similarly as well. The PAT has gone up from just about 12 crores in FY21 to 212 crores in FY24 to a projected PAT of about 280 crores expected in FY25. That is this fiscal year. The company has managed to grow consistently in the last 8 years at a CAGR of about 34%, and EBITDA grew by 38% during the same period. The last 3-4 years have been really impressive due to blockbuster growth in their products division, the division which manufactures ACs, water coolers and washing machines. The AC business grew about 10x in just 3 to 4 years, and while the washing machine business grew 6x in 3 years. For the current fiscal year, that is FY25, the numbers are quite impressive. Revenue for 9 months ending FY25 for the first 3 quarters is up by 77% as compared with the 9 months ending FY24. EBITDA is up by 85%, PAT by 120.9% and PAT margin by 3.9% to 4.9%, while EBITDA margin increased as well from 9.3% to 9.7%. Out of the total revenue of 2,759.67 crores of revenue in first 9 months of FY25, products business share was nearly 70% with a revenue of about 2012, that is 2012 crores. The room AC or the RAC business was the key growth driver for FY25. Its revenue was 1,636 crores, which is nearly 55% of the total revenue reported by the company in the first 9 months in FY25. The RAC business actually grew by 154% year over year, while the washing machines business grew by around 49%. One of the major reasons why the stock price kept rising during the last 1 year is because of the continuous upward revision of the expected revenue by the management for fiscal year 2025. In the con call for quarter 1 results, the management said they expect about 3,650 crores of revenue with 216 crores of PAT for FY25. Then they revised this to 4,250 crores of revenue with 250 crores PAT in the quarter 2 results con call. And now in the quarter 3 results con call, they are saying that they have guided for a figure of 4,800 crores of revenue with 280 crores of PAT for the entire fiscal year, which is FY25. This revised guidance is mostly driven by the growth in the products division. Management had initially guided for a growth of 58.8% with over 2,650 crores revenue in the quarter 1 results conference call. Then they revised it to 78% growth, year over year growth, to over 2,975 crores in the quarter 2 conference call, and now the management is projecting a year over year growth of 97.8% to over 3,300 crores of revenue in the most recent quarter 3 conference call, which just happened just a few days ago. About 72% of the total revenue for FY25 is expected to come from the products division. So we saw a little bit about the financials of the firm. Now let us talk about the expansion plans and the future growth potential for the firm. Based on the tremendous growth seen by the firm in the AC manufacturing business, the company has set up a new plant for AC manufacturing in Bhiwandi, Rajasthan, and another greenfield expansion for ACs in Supa, Maharashtra. The company will increase its manufacturing capacity for ACs to 3 million per year with these facilities expansion. To meet the demand for the washing machines, the company has set up a new plant in Greater Noida region and also is enhancing the capacity of their existing plant in Roorkee. The total capacity is expected to go up to 2.4 million washing machines per annum. That is, about 2 lakh washing machines can be manufactured every month with these expansions. For FY25, the company has planned for a capex of 370 to 380 crores, and majority of this capex will be used for these expansion plans by PGEL. So with these enhanced capacities for ACs and washing machines, the company hopes to meet the growth targets that they have set for the next 3 to 4 years, or at least 2 to 3 years. The revenue growth target that has been set by the management for PGEL is 35 to 40% per year for the next 3 years. While the room AC business is expected to grow by 40 to 50%, the washing machines business should see a growth of around 35 to 40% every year. So that's the growth story on the products division. For the plastic molding business, the growth expected is about 20 to 25%. Another noteworthy segment of their business is the electronics division, which manufactures TVs and also does PCBA, that is PCB assembling. About 300 crores of FY24 revenue came from the electronics division. In May 2023, they entered into a 50-50 joint venture with the Jayana Group, known for brands like Carbon, Gioni, I don't know the way to pronounce it, Sansui and Sense. And it's one of the very few manufacturers in India who holds the Google ODM license for manufacturing smart LED TVs here in India. So together with Jayana Group, PGEL has formed a company called Goodworth Electronics. So Goodworth Electronics will be manufacturing Google certified smart LED TVs. They also have plans to broaden the product range to include refrigerators, IT hardware, wearables, hearables, and so on and so forth in the future. The management has guided for a revenue of about 550 crores in the FY25 from the electronics division from this partnership. One of the surprising announcements made by PG Electroplast recently is that they are getting into manufacturing EV two-wheelers. They have partnered with a company called Spiro Mobility, an African company which is one of the top EV two-wheeler manufacturers in Africa, to manufacture electric bikes and scooters for the Indian market. Now you must be wondering, why is an EMS company getting into a highly competitive EV space? Well, it's not as crazy as it sounds. PGEL already manufactures automotive components for brands like Hyundai and SMR, auto parts like handle bases, assemblies, mud flaps, rear view mirror housing, center bezels, dashboard trims, etc. And these products are manufactured from their plastic molding and the tools division. They have PC assembly expertise from their TV business, which is one of the key requirements for manufacturing EVs. PGEL's role in this partnership will be limited to manufacturing only. Spiro will provide the specs and the design. They will own the IP. PG Electroplast will make everything from battery packs to plastic parts and then hand over the finished product to Spiro for marketing and sales. So Spiro will do the marketing and sell the vehicles coming out of PGEL's factories. Production kicks off in Q1 of fiscal year 2026, just a few months from now at their Pune plant. For this venture, PGL is not spending much. They are just spending about 40 to 50 crores of capex over the next 2 to 3 years. So the question naturally that comes to one's mind is, how are they able to pull this off? The management has to say that most components like motors, batteries and MCUs will be sourced externally with only about 20% value addition or wallet share happening in-house in PGEL. The focus will be to achieve high asset turnover and strong RAC with similar margins from their AC and washing machines manufacturing business. The company hopes to make about 500 crores of revenue by FY27 by investing just 50 crores in the next 2 to 3 years. That's a 10x asset turnover with a 20 to 25% ROCE. One of the reasons why PGL could manage with a low capex of 40 to 50 crores is probably because of their existing manufacturing setup of plastic molding, tools and the PCBA. Spiro's big goal is to sell 2 lakh EVs a year through the quick commerce platforms here in India, and this will translate to big manufacturing volumes for PGEL and hence the revenue target of 400 to 500 crores in just about 2 years from now. But still, this is a big number indeed, and only time will tell if they will succeed in this. My thinking is, even if this partnership fails to generate enough revenue, any positive experience coming out of it will help bring more EV players to outsource their manufacturing to seasoned manufacturers like PGEL. Lastly, I want to bring to your attention the fact that PGEL raised about 1,500 crores via QIP in Q3 of this year. It's not very clear why the management raised so much money. It has not specified exactly what they are going to do with this. All they said was they are anticipating a growth of about 35 to 40% in the coming 2 to 3 years and or the next 3 to 4 years, and they are just preparing for the same. They insist that the money will go to fund new projects, new products, new product categories that they will be venturing into in the next 2 to 3 years as part of their growth plan. And yes, the money raised will also help fund their EV manufacturing. So now that we visited the expansion and growth plans for PGEL, let us look at certain other details of this company. Let us look at their balance sheet, their debt to equity ratio and also the shareholding. And finally, we will look at the valuation part as well. The debt for the company is around 377 crores and net debt is now negative, that is minus 793 crores due to the 1,500 crore QIP that was raised by the management. ROCE has increased from 19.8% to 23.5% year over year, and ROE has increased from 16% to 19.1%. The inventories have gone up considerably from 543 crores in March 2024 to 1,025 crores in Q3 of FY25. As I will explain shortly, this inventory buildup is happening in anticipation of supply chain disruptions that could occur in the coming months. The promoter shareholding for the company is roughly 50%, which is fine except that it is decreasing year over year. It has gone down from 65% to 49% in just about 2 to 3 years. However, the share of FIIs and DIIs have increased correspondingly from almost 0% in March 2022 to 10 plus 16%, which is 26% during the same period of 2 to 3 years. While the promoters and the public shareholding has gone down, the correspondingly the DIIs and FII share has gone up, which is a good sign. Next, let us look at some of the risks and challenges the company faces that an investor should be aware of when putting their money in this business. One of the challenges being faced by PG Electroplast is the supply chain disruptions that we touched upon earlier. And this supply chain disruption is happening mainly in the AC manufacturing business. This was highlighted by the management in their Q2 earnings call. The problem arises from the fact that government has now mandated BIS certification for all the imported AC components, and this is delaying critical supplies for the AC manufacturers. Indian AC manufacturers still import about 60 to 65% of the AC components like compressors, PCBs, fan motors, copper and aluminium, mostly from China, Thailand, Taiwan and Malaysia. The central government is pushing for the local manufacturing of these components as part of the Make in India initiative, and hence is delaying or refusing BIS approval for many of the Chinese suppliers of critical components like the compressors. This means Indian AC manufacturers are struggling to get key parts on time, and anticipating this disruption, PG Electroplast or PGEL has been stockpiling inventories to ensure production is not affected, at least until March 2025. But if this situation is not resolved, the shortage of critical components could hit hard, just like it has for their competitors like Amber Enterprises and EPAC Durables. Aim of PGL is to grow by 35 to 40% every year for next 2 to 3 years, but supply chain constraints could slow down production and hurt their revenues in the short term at least. Also, it has been observed that Chinese suppliers are now diverting shipments from India to US for better margins, better returns, making things worse. The industry is appealing to the government to resolve the BIS crisis, but right now there is no quick fix in the sight. This is not the first time that government certification delays have impacted an industry. E-bus makers like Olectra and JBM Auto face production halts when government jumped in and said we will allow only those battery packs which are certified by us to meet our safety standards. The battery supplier BYD took months to get the certification, to get the approvals, which caused significant revenue losses for the e-bus manufacturers like Olectra and JBM Auto. Apart from the possibility of supply chain disruption in the coming quarters, which may be temporary one, there are other risks which are inherent to the nature of this business. Major one, of course, is the cyclicality of the AC business. AC sales skyrocket in summer, that is in the March and June quarters, but they drop sharply in winter, that is in the September and December quarters. Historically, revenue in the peak quarters is more than double that of the slow quarters. PGEL's competitor Amber Enterprises EPS even turns negative in the weak quarters. The business can vary not just from quarter to quarter but also from year to year, depending on the temperatures recorded for that year. The record heat wave last year helped the AC industry to grow by 35 to 45%, benefiting manufacturers like Amber Enterprises and PG Electroplast and the EPAC Durable. The average growth is about 15% for the AC industry. Just because we saw record growth in the last year does not mean we'll see similar growth next year if the temperatures return to the normal levels. But do note that PG Electroplast growth in its room AC segment was much higher than the industry growth of 35 to 40% recorded for the last year. The recorded growth for PGEL is 150%, which is 3x the amount of average industry growth, and hence we can assume that the growth of PGEL was more due to new customers and increased orders and not driven by the heat wave. Lastly, there is a risk of intense competition or pricing pressure in the industry. AC contract manufacturing is a commodity business where margins are low. Competition is high from big players like Dixon, Amber and EPAC Durables, who are the competitors of PGEL. The features and designs for home appliances have been long established, and there is little room for manufacturers to achieve product differentiation or technical innovation. The contract manufacturing firms like Dixon, PGEL, Amber often compete on the price, and it forces them to accept thin margins from big brands. The reason why this is still a profitable business is because the volumes are high and the capex is low. The asset turnover is quite high, leading to an ROC of about 20% plus. Companies like Dixon and PG Electroplast thrive by maintaining high asset turnover and rapid growth. Finally, let us look at the valuation part. The PE is on the higher side, about 110. However, now that the company has guided for a PAT of 280 crores for FY25. The PE for FY25 will come to about 87. The market cap is currently about 24,000 crores. If we assume the company will grow by 40% in FY26, the PAT can be expected to increase from the currently guided figure of 280 crores for FY25 to about 390 crores in FY26, which means the forward PE for FY26 will work out to about 59 or 60, around 60. I found the valuation to be more reasonable when compared to the competitors like Dixon and Keynes. So that's it, folks, for today. Let me know in the comments if you have any queries. I'll be happy to answer them for you. Thanks for watching and have a great day.